All right, welcome to day 15 of our 50-day series. Today, we're going to talk about that heart-stopping moment when you see the market has made a huge move and you haven't even had your morning coffee yet. Yep, we're diving deep into market gaps.
Okay, just picture this scenario. You wake up, you grab your phone, and you open your trading app to check the market. And bam! Nifty is already down 300 points. But wait a second, the market isn't even open. You've literally done nothing, and you feel like you've already missed this massive move.
That feeling, that mix of confusion and, let's be honest, a little bit of panic, what on earth just happened?
That right there, my friend, is what we call a market gap. And today, we're going to turn that feeling of panic into a solid plan.
So what is a market gap? Yesterday, we talked all about volume, right? About how to judge the strength of a move during the day. Well, a gap is a completely different beast. It's the move that happens when the market is closed. Basically, a market gap is exactly what it sounds like. It's that empty space you see on a chart between where the market closed yesterday and where it opened today. It's a jump or a drop that happens overnight while we're all asleep. And here's the kicker, and this is so important to get. It's not a move you can trade during the day. It's a move that already happened before you or I ever got a chance to react. It's done and dusted by the time the opening bell rings. Let's make this really simple. You've got two main flavors. A gap up is when, let's say, Nifty closes at 22,800, but the next morning, boom, it opens at 23,000. It just jumped up. And a gap down, you guessed it. It closes at 22,800 and opens way down at 22,500. The price just dropped. It's as simple as that. Okay, so the big question is why? How can the price move so much when the market is technically closed? Well, the answer is pretty simple. Our market might be sleeping, but the rest of the world sure isn't. Just think about everything that can happen between 3:30 p.m. one day and 9:15 a.m. the next. The U.S. markets could have a wild session. Some huge piece of geopolitical news could break. Maybe the RBI drops a policy announcement after hours. Or a major company releases blockbuster earnings. All of this new information gets processed and priced in before we even get a chance to log on. I want you to remember this line. Markets move even when you are sleeping. Just because our market is closed doesn't mean the world stops spinning. It's constantly digesting information. By the time it opens, it's already adjusted to everything that happened overnight. All right, so now we get what a gap is and why it happens. Now for the really important part. What happens next? What do we do about it? Does the market just keep running in that direction, or is it going to turn around in reverse? Well, there are really two main scenarios you'll see play out. First is what we call a gap and go. This is when the market gaps up and just keeps on climbing higher. It's a huge sign of strength and momentum. But then you have the gap fill. This is super common. The market gaps up and then slowly drifts back down to fill that empty price range. This usually suggests that initial burst of excitement didn't have enough power to last. Now, professional traders have all sorts of fancy names for these, like a breakaway gap, which can start a new trend, or a continuation gap that keeps an old one going. Those are your classic gap and go types. On the flip side, an exhaustion gap is often that last gasp before a big reversal. You don't need to memorize all the jargon today. Just understand that the context of the gap really matters. Okay, so let's get practical. Let's turn all this theory into an actual game plan. So the next time you wake up and see a giant gap, you're not going to panic. You're going to be prepared. I want you to burn this phrase into your brain. The open is information. The next move is confirmation. All the gap tells you is what happened overnight. But those first 15 to 30 minutes after the market opens, that's the market telling you what it really thinks about that news. So here's your checklist for a gap day. Number 1, try to figure out why it gapped. Is there some major news? Number 2, and this is the most important rule, do not chase. The first 15 minutes are absolute chaos. Just sit on your hands and watch. 3, see what the market does. Does it try to reverse and fill the gap, or does it hold strong and continue? And number 4, check on your existing positions first before you even think about a new trade. And here's a super practical way to think about it. If you see a tiny gap, less than, say, 0.3%, it's probably just noise. Business as usual. A medium-sized gap, maybe up to 1%. Okay, now you're paying attention. See if it fills in that first hour. But a big one, over 1%, That's a red flag. That's your signal to stop, take a breath, and find out what major event happened before you do anything. Okay, before we wrap up, let's talk about the single biggest mistake that beginners make on a gap day. I want to make sure you never fall for this trap. This is it. You see the market gap up 200 points. That FOMO, the fear of missing out, kicks in so hard. You think, oh man, it's going to the moon. I've got to get in now. So you panic and you buy. And then you just watch in horror as the price slowly drifts back down, filling the gap and leaving you sitting on a loss right from the start. Now be honest with me for a second. Have you ever done that? Have you ever chased a big opening move only to get completely burned? Look, if you have, you are not alone. Most of us have been there. But from today on, you know better. You have the framework to avoid that trap. And that is our deep dive on market gaps. Tomorrow, we're going to tackle another really confusing scenario for beginners. Why is your stock falling even when the Nifty is soaring? It's all about a crucial concept called sector rotation. You don't want to miss it. I'll see you then for day 16.